Hi everyone, my name is May Reyes of Reyes Group Australia, Accounting and Taxation. I am your accountant and we are here to discuss Self-Managed Super Fund, or what is most famous of its acronym called SMSF. If you want to use your investment property portfolio to fund your retirement, SMSF is a great vehicle for you to achieve it. I'll explain it to you. There are four business structures, namely sole trader, partnership, company, and trust. Self-managed super fund falls under the trust. You could see and differentiate these different business structures by looking at the different tax rates. And we are going to focus on a self-managed super fund, which is taxed at a rate of 15% fixed. So why SMSF? 1, there's money contribution in it. 2, there is a leverage. And 3, there is a tax savings. I'll explain this in details. Money contribution. There's already money balance sitting on your super. Let's say you would like to buy a property and you don't have enough money for the deposit. In regards with the self-managed super fund and that balance on your super, you could use that as a deposit to buy a property. Not only that, there's a top-up of an employer contribution. So every time your employer's putting money on your super, it's actually add as a top-up. That employer contribution is 9.5% of your gross pay. There's also a concessional contribution to a maximum of $25,000. And with regards with that one, that could be your salary sacrifice or a voluntary contribution, which is a tax deductible as well. Oh, leverage. So that is the difference between your typical super and your self-managed super fund. Your typical super could not get a loan, while your self-managed super fund could actually get a loan. Loan is basically using other people's money that gives you a leverage which magnifies more your return of investment. You might want to speak with our mortgage broker to see if this is something could be done for you. Tax savings. As I previously discussed, for every income you incur with your self-managed super fund, there's a 15% tax on it. And also a capital gains tax of 10%. If you're not familiar with the capital gains, let's say you bought a property and you sold that property and incurred an income of, let's say, $500,000. That income is called capital gains. And that capital gains is subject to capital gains tax. In relations with the self-managed super fund, if you hold that property for more than 12 months, it will be taxed at 10%. And lastly, the self-managed super fund, when it goes to a retirement phase, when you reach 60 years old and up, it's now 0% tax. So forget about this 15%, forget about this 10%. If you are already on a retirement phase and you're reached 60 years old, it's already 0% tax free. So back on our previous questions, if you want to use your investment property portfolio to fund your retirement, SMSF is a great vehicle for you to achieve it. Reason being is this: it's already tax free. This is May Reyes of Reyes Group Australia, Accounting and Taxation. We love numbers. so you don't have to.